We're going to be covering gold. Haven't done it in ages. What have we got?
So gold, investing in gold, what we've seen since the autumn of 2022 is the price of gold rally by 20 to 25%. So it's a big rally. So there'll be people out there who understandably are interested. So firstly, why has gold rallied so much? Part of that is down to interest rate expectations and monetary policy. So if interest rates are going up, it tends to be bad for gold, and that's because gold doesn't really yield anything. It's just a lump of metal, and it tends to trade based on people's fear of the unknown or uncertainty of some kind. So it could be when there's like the debt ceiling is something I mentioned last week. Gold has done well in the environment at the moment because people buy it as a haven asset. So gold has rallied quite well because people are starting to think, well, maybe there is a recession on the cards, maybe in the US, other places. So the price of gold has gone up, and it is another asset to diversify a portfolio. I'll come on to the amounts to have in a portfolio based on research that I've carried out on 80/20 Investor in the past, which I'm updating actually, which is showing some interesting trends. So people can invest in gold in multiple ways. It could be coins, it could be bullion, so they actually own gold directly. But the most likely way that people would invest in gold is through ETFs, so exchange traded funds, or versions of them. You get things called ETCs. They don't need to get bogged down into the difference between those, but it means you can invest in the price of an ounce of gold. So as the gold price goes up, you can therefore benefit from that. The other thing you can do is you can invest in unit trusts out there that invest in gold as one of the things they invest in. So you'll see a fund, it might have be a gold fund of sorts, but what they also do is they invest mainly in mining companies, so gold mining companies. Now you've got to think that adds another layer of volatility to what is already a very volatile asset. So gold's price, if you go and look at the price of gold, if you've got an iPhone and you open the stock market app and you type in GC equals F, that's the code, you can see what the latest price of gold is, and you can see that it goes up and down. In fact, when you look at it, it just looks like a share price in terms of that volatility, those ups and downs. If you invest in a fund that invests in mining companies, it adds another layer on top of that, because don't forget, you're not just investing in ultimately having exposure to gold's the price of gold, but also the viability of the mining company itself. Now, when the price of gold is going up, it can be obviously good news for mining companies because their costs tend to be fairly fixed, and therefore they'll make more profit, so that will amplify your returns. That's the theory. But of course, you can see that in the other case, if the gold price goes down, then gold mining companies could also be places that you could see a lot of volatility, because if the price goes down, they make less profit if their costs have gone up because they've overinvested at a point in time. So be aware that if you buy a fund, particularly a unit trust, and it has gold in the name, look to see what it's investing in, because you'll probably find most of it's going into mining companies, so gold mining companies, which increases the volatility on an already volatile asset. So that part out of the way. If you are going to invest in an ETF, it's likely you're going to end up investing in one that is going to give you exposure to the physical asset. So the ETF holds the asset itself. There are different versions which give you exposure via different types of financial instruments. So they don't actually own gold physically. They end up having exposure via these financial instruments, which again gives another risk, because obviously those financial instruments, the way they're made, they could effectively blow up. So won't dwell on that, but that's something to bear in mind. So in my 80/20 investor portfolio, I do invest in gold. I hold a certain amount via an ETF that invests in physical gold. So I crunched the numbers back in 2015, looking at the impact of holding different amounts of gold in a portfolio. And I had a typical portfolio split between bonds and equities. You can see the research if you sign up to a free trial of 80/20 Investor, and I'm just about to update that as well. And the research at the time showed what would happen if you held, say, 5% of your portfolio in gold, 10%, 15%, and the rest of the time you're holding the rest of the assets in your portfolio were split between bonds and equity. So we were keeping a base portfolio, but seeing what would happen if you added gold to it. And what it showed is that holding a small amount of gold does reduce the volatility of your portfolio, but it's not a hedge against volatility, because the more you hold, the more gold you have in a portfolio, actually starts to increase that volatility. And interestingly, if you look at a portfolio, so let's say you just held 100% gold, that over the last 10 years would have produced a more volatile portfolio that's just invested purely in gold than if you'd invested in 100% equities. So it is more volatile. Over the last 10 years, that just shows you that it is not a hedge against volatility. But what it does is that obviously in an environment, if you go back and look at, say, last year was a good example, 2022, when equities and bonds struggled, or when you go back to the pandemic, 2020, the price of gold can move in a different way. It's uncorrelated generally to bonds and equities. And so even though it's a volatile asset in itself, if it's doing something that's very different to the rest of the things in your portfolio, it can bring down your overall volatility. Because you think about it, if equities and bonds are tumbling, but gold is going up in the opposite direction, they can start to counter each other. So that gold can start to provide some uplift to your portfolio, which reduces that volatility. And what we found back then was that if you held more than 5% of your portfolio in gold, it starts to increase the frequency of your losses. But having more than 5% of gold in your portfolio also started to increase the volatility of your portfolio. So it started to suggest that around about 5%, maybe to 10% would be the sweet spot to have that in your portfolio, and it works differently. Now, what is interesting, when I performed that piece of research back in 2015, recent history always influences the outcome of any research that you do, and you have to be mindful of that. And so a lot's happened since 2015. Two examples: the pandemic, and we had obviously the Ukraine war and the spike in inflation, and we've seen some incredible market movements. Last year, bonds had their worst year in basically 100 years. Equities had a terrible time, and so gold really did come to the fore at different points. It wasn't always going up throughout the year, but at different times of the year in 2022 and during the pandemic, it did become a good diversifier and provide some positives to a portfolio of, say, bonds and equities that would have been tumbling. And so I updated that research, and it's interesting to see what came out the other side, because this time what I did is go, well, okay, why don't you just increase the cash exposure in your portfolio rather than put the money in gold? And what you find is that if you're looking for a portfolio that has the lowest volatility, of course, if you start moving more and more into cash, then the volatility will start to go down. But what happens is obviously your returns start to get hit. But I looked at a portfolio that had all sorts of exposures to cash, so from 5% all the way through to 30%. So looked at 5% gold exposure, 10% gold exposure, 15% gold exposure, repeating what I'd done in 2015 in the research, but also said, well, what would have happened if instead of gold we just used cash? And what's really interesting is that if you held a 10% gold in your portfolio, it had one of the lowest volatility measures for a portfolio than if you'd held large sums of cash. Wow. So let's just take 10% gold versus 10% cash. The 10% gold portfolio was less volatile than a portfolio that had 10% cash weighting. And so that showed you that it was a better diversifier in terms of volatility than cash. So gold was the winner there. But what is interesting is that if you looked at the returns, obviously the portfolio with gold in it did significantly outperform the one that had just cash. It didn't have any gold in it. So the message is that gold is a good diversifier, but in fact it was a better diversifier than what we probably realised, because when I did the research last time, there weren't any tough periods, extreme market conditions in the years before 2015, not in recent history. But in the interim, we've had two massive market movements, and therefore a portfolio of exposure to gold, you've really seen the benefit of that. So the message from this part of the podcast is that, yes, putting cash in your portfolio, it will reduce volatility, but actually what happens, that does reduce volatility when you start having large cash holdings, 20, 30%. But if you have anything around 10% cash, actually gold does a better job of reducing volatility. And in recent years, it's actually helped boost returns. Of course, you could have periods where gold has done poorly. Now, 80/20 investor members will be able to see the full research and look at what the sweet spots are in terms of gold exposure. But it does seem to confirm that heading towards about the 10% exposure to gold has a merit when it comes to investing and diversifying in recent history. I have about 5%, so between 5 and 10% still seems to be a good level for gold. More than that, you do start to increase volatility. So it just shows you gold does have its place. It's not a hedge against inflation. It's not a hedge against volatility, but it is a good diversifier in a portfolio. So people out there who may be already invested in gold, or they might be interested, might be sitting there thinking, well, if gold has actually hit a multi-year high recently, what is the prospect for it going forward? Now, obviously, I don't know what's going to happen to investment markets, but we do technical analysis as part of 80/20 Investor, and I've just done a new piece on that for gold and silver. I'm not going to cover silver. That's the other precious metal that we look at. I'm going to just talk about gold on this. Now, what is interesting is there is a phenomenon in technical analysis called a cup and handle. I'll put a image on the article on the website that relates to this particular episode. And what you've got to imagine is if you go back to 2011, that the market for gold, the price was up around about 1800, 1900, and then it fell away. But as time passed, you imagine it forms a bowl shape. So it starts to pick back up as we get into like 2018, 2019. So it's fallen, but it's made a nice curve. And then it gets back to roughly where it was before when we're looking at about 2020. And that's obviously around about the pandemic. And that bowl shape is what you call the cup. So imagine like a cup of tea. And then the pullback that we had at that point then started to unwind. We start to get a rally again in the back end of last year. And you can imagine it starts to form a handle. So it's like two semicircles side by side. One big deep one, that's the main cup, and a much, much smaller one, which is the handle. That cup and handle formation, technical analysis, is actually normally a bullish indicator. So if it does formulate and actually complete, it might suggest that there's actually positive news for gold ahead. Now, of course, these things can just unwind and it can negate the whole pattern, but it is interesting to see these patterns play out over a long period of time. And when I did the analysis about 2 years ago for 80/20 Investor, I pointed out that there was a good chance we could see a significant pullback because of this pattern. We completed the first stage of that bowl. Could we now, when the handle starts to be formed, see a significant pullback? And we did. So it's an interesting phenomenon. I'm always intrigued by technical analysis. The point is that gold has had a good run. Does it mean it's over? No, not necessarily. There could be signs that we could see more upside, but of course, who knows what will happen. So in conclusion, for this part of the show, gold is a good diversifier. It can help reduce volatility in a portfolio. Too much of it will do the complete opposite. If you do invest, do look at alternative asset classes because they can have benefits, as I've shown. And don't just focus on bonds and equities, because if you do and you get a year like 2022, then the lack of diversification can end up hurting you.